sky. That's the masses inside.
Welcome back to Gimme Some Truth. Keith and I are in the booth. It's been a little bit.
We haven't been in together in a while, years even.
I don't know about years, but it's we're doing a vibe session? Is that what
That's kind of the topic. Talking about the vibes. Because if there are two guys that really like vibes, it's you and I.
Totally.
And I think really actually we're going to talk about the disconnect between the vibes and people's attitudes. But before we get into that, we're those of you who are viewing us on the YouTube channel can see our outfits, but there was some strategic planning that went into each of our outfits because we were worried that we might look too much alike.
That's right, and we accomplished that.
Yeah.
And now I think next time we're going to have to totally wear the uniform.
Yeah, well, gingham shirts.
Definitely.
If you're ever in the office, you may see us, and there'll be like 3 or 4 gingham shirts on average. It ends up that way.
We've almost had it like a gingham shirt ban.
Yeah.
In the office, so then everyone started to go away from that, and I think people are having some difficulty because we need to start going back. I think.
I mean, it's a great shirt. I own 2 or 3 gingham shirts.
As do I.
Yeah,
at least.
I have a pink one. I have a sky blue, a darker blue. But what are we talking about when we talk about vibes session?
I mean, really, right now, there's an enormous disconnect between consumer sentiment right now and the actuality of where the economic data is coming in. And so it's definitely worth a discussion and kind of going through the reasoning behind why we think that sentiment is so bad. I mean, it's multifaceted, certainly.
Yeah. Well, and so just to kind of give you an example, the jobs report came in this morning. We're recording this on the morning of November 3rd. I had to check the date there.
That's okay. I do that all the time.
Yeah. But the headlines on the New York Times about the report were, largely it's good. 150,000 jobs under normal circumstances, we would be, pretty good. But the headline under, U.S. job growth shows signs of slowdown, but we're still adding jobs under 4% unemployment. Very good numbers. And then the headline underneath that is consumer sentiment has become gloomier, but the overall economic picture remains bright. And so it's the measures. And usually when people talk about consumer sentiment, they talk about the University of Michigan consumer sentiment survey. And one of the interesting things, and there are a number of ways that you can look at it, The Economist about a month and a half ago did an article where they kind of did a regression analysis for seeing essentially how various factors contribute to consumer sentiment. And they looked at, I think it was 18 factors over kind of 20 years of this survey, and they assigned each of these an effect on the kind of survey. And they said, well, we should be at like 98 on that. And instead we're
a far cry.
Yeah, we're 30 some points lower than that. The other gap that you see is, a huge gap between people saying about, the state of the economy as a whole is bad, but my personal situation is pretty good. I think it's like a 25 or 30 point gap between the two, depending on the time and so on. So it's this sort of thing that we're talking about. And then, I know the plural of data of anecdote is not data, but I think, in talking to our clients, there's a certain amount of negative sentiment that comes along. When we talk to research analysts at the various bigger banks that we work with or investment houses or so on, there's a lot of, negative sentiment. I last week, I think it was, we were talking to a researcher in one of those areas who had stopped by the office, and it was the day before the GDP number came out, and it was talking about, we're getting ready for a recession and this and that. And then the number was 4.9%, like, blew the doors off.
It's phenomenal.
Yeah. I mean, record setting. So, there is clearly a gap. And I one of the reasons I think we want to have this podcast is people are feeling down. And so, what are some of the reasons why people are feeling down?
I mean, there's there's so many, I think. Number one, I do think that the media has just seized on this idea that recession is imminent, and the investment houses are not immune to that too.
Yeah.
And, if you look at it really objectively and you kind of look at all the Fred data, which is the data that comes out of the Federal Reserve, as interest rates are raised and they peak pretty much every time in history, there is a recession that's come on the other side. And so because we have so much data on that, I think that everybody feels this recession is imminent vibe. And I don't know. I mean, maybe we see one, maybe we don't, but we're a far cry away from these GDP prints of getting into a recessionary environment as far as the data would tell us. Yep. So that's one thing. I think we do have a ton of tribalism too. I mean, whether you're a Democrat or Republican, there's just a lot of infighting. And so, Bidenomics is trash, and, we need to go back to Trumponomics, and then, Trumponomics is trash, and this Bidenomics stuff isn't so bad. And so it all depends on what side of the political spectrum you're on, and either way, you're not feeling as strong there. But we don't really care about that. We're looking at the data, and the data tells us is that, yeah, it's pretty strong. If you're an extreme skeptic, you're saying, this is just the hangover from the extreme spending that has happened. And if you're not a skeptic and you're saying, you know what, our economy looks pretty good right now, even though we've been through some inflationary times too.
Yeah, and I think that's part of the vibe session, or the feeling. And when you look at how economists treat inflation, numbers have started coming down, and they're getting closer to historical averages. They're not yet at necessarily, depending on, and inflation is also one of the notoriously hardest things to measure, one of the hardest things to track. You hear PCE, you hear CPI, you hear core CPI, you hear core CPI excluding. And so what people react to is their sort of sense of prices. And one thing that economists have said is that even if there's a rapid upswing, people feel that for longer than, maybe it happened. Right. So, inflation may be cooling, but, the price increases last year, people still go to the grocery store and they're like, boy, that's pretty expensive. I do that all the time because I want candy bars to still be 50 cents, but, that's not the world we're living in. So I think there is a little bit of an inflation hangover out there. And it's also, I think, why, economists were so worried about inflation when it reared its head, even if, you thought, it might be transitory or something like that there was this need for action, which we saw with the Fed really coming out and raising rates, and kind of putting things on board. The other place where I think that you're seeing this is, the headline in the Economist piece was a key measure of consumer sentiment is broken. And I think part of it is data right now is really hard post-COVID because so many things shifted in such a small amount of time that people just don't know, and
that's accurate.
There's the old saw, the market hates uncertainty. I do think as well that the market has played into people's sentiments as well.
Yeah, it's not as fun to trade anymore. I mean, I remember sitting during the COVID time, everyone was going through their COVID depression, but boy, was it fun to trade. And, and then, yeah, a lot of the names that people got kind of sucked into have done very poorly over the last couple of years. Sill just came out and sent us an article where it was like in the S&P 500, there's 8 stocks that have really contributed to all the rate of return of the S&P 500, and 492 stocks is basically like even, if not down slightly. So it's not a great market as far as, this is not a broad-based, stock recovery here. It's very concentrated in the stocks. So if you own the exact right stuff, we've heard a few clients, how come I'm not getting S&P 500 returns? Well, because you're not in the S&P 500 for all your assets. Like, if you're not in the S&P, you really have not had a great investment experience this year or last. And so there is that hangover, that wealth effect, that compounding wealth effect is definitely not occurring right now.
Well, and even if you're in the S&P, if you're not in the, right parts of the S&P, you're not seeing it, and related to that, I think if you look at, where the market was at the beginning of 2022, and you talked about the wealth effect to where it is even, after the most recent pullback, people aren't yet back to that high water mark. And that's where a lot of times that anchoring bias comes into play, right? We think the times are good when we're above that anchor, above the previous time. And never mind that anchor, stock market may have been overvalued. Things might have been, too hot. That anchoring bias comes in.
Well, then you normally got the bonds to be that buffer, and that has not occurred since we saw kind of a 300-year flood in the bond market. I mean, really, it washed out 10 years of returns in the bond market went to crap, really. So, it is a odd situation in bonds. I do think that there's a reasonable case to be made that bonds are going to be sexy again. So it's not a bad thing necessarily that we have this sort of reset, and now we have higher yields in those bonds, and we're getting back to a little bit more normal bond market where you're going to get some money from the bonds that might actually offer you a little bit of that buffer in the future.
No, you'll be getting that coupon payment, which, remember in 2022, 2021, there were no coupons. Bond rates were at 0, and you can do your best to protect because rates are going to go up. But I also think, the speed with which they went up was crazy. Crazy fast. The Fed felt they got arrived a little late to the party. But the other thing is, when you look at it from a historical perspective, 5% interest rates are kind of normalish.
Very normal.
Yeah. Don't want to sound like two old guys sitting around, but, if you're our age, go and talk to your parents about what their first mortgage was in, the early 1980s and what the mortgage rate is. And so 8% mortgage rates, historically in range. And so that's one of the other kind of things that I think a lot of, forecasters are looking at. They're like, oh, these interest rates have come up and so fast. And, when you're in this kind of tightening cycle, recession will follow. But it's not a typical tightening cycle. We're not, tightening from 4.5% to 8%. We're tightening from 0% to 4.5%, 5%. And so that, really changes the math there. And I also think now, like everything, back in the spring, a lot of bond market folks were saying, well, they're going to start cutting rates by, 2024. And they kind of got that one wrong.
They got that way wrong.
Yeah.
Yeah. I mean, people have got to appreciate a bit more about how these cycles just take time.
Yeah.
The Fed raises rates and there's this effect. Usually it takes about 18 months to let these interest rates bleed into the economy. Well, you think about how many times they raised rates and you reset kind of an 18-month clock on top of each one of those. And, there's a lot then that can happen between, our recent interest rate increases and the actual impact it will have on the economy. So there's a lot of that to consider. I do think that the hangover effect and kind of the negative malaise that we're feeling is that, the Wall Street Journal and others are always printing, mortgage rates hit X amount. And so people feel bad about that. But they actually should be feeling the exact opposite way because so many people have really good mortgage rates. Yep. And you're going, well, thank God you're in a great mortgage rate.
Yep.
Yeah, congratulations. Now you don't have to really worry about that. It does mean that you probably can't move, but because you're looking at significantly different real estate environments than we saw in the past. I mean, it's just.
But it is also a case, I think, that gets underestimated when we think about the American economy. The American economy is flexible, right? And so one thing that you're seeing is, first of all, higher interest rates, what that means, because the way people think about their houses, they think about their monthly spend, right?
Right.
The equivalent of rent with my mortgage. And so that are, with those really low interest rates that pushed house prices high, so as time ticks on, you don't usually see house prices fall off a cliff.
Right.
They just don't increase as fast. So you probably will see that play out. So it'll take some time, as you said, but also new home builders are coming in and saying, well, we're building houses. We need to build houses. There's a market for these houses. Hey, we'll, get you a mortgage, 2 points lower, a point, or, and that's something you can do as a new home builder that you can't necessarily do when you're purchasing existing stock. So you're seeing new homes continue to be built, continue to expand, continue to kind of go in the right direction. So I think, people are underestimating the adaptability. The other thing is, we're talking about these interest rates. We're finally at what we would call real interest rates, right?
Yeah.
Where that's finally where you're going to see the economy grind a little bit on interest rates. Is not from, just interest rates in a vacuum. We're raising from 3 to 3.5. If inflation is 5%, you're still not feeling that effect on the economy because businesses go, well, I can borrow money and, it's going to be so much cheaper still in the future. So you haven't seen that yet. And, that 3.5% yield doesn't really matter if, the dollar is decreasing by 5% annually. And so I think that's the other thing. We're finally seeing real interest rates. And it's going to take some time for that to bleed out into the economy. I mean,
people need to get used to that. And then you talk about other consumer sentiment things, obviously geopolitical events. We'd have to mention that as well. So that's one item too. They just feel bad. The negative news cycle continues. Like, has the news in the last 12 months ever reported anything that's positive? I just don't. I think it's just constant negativity. Yeah. So you get pounded over the head with that message that things are bad and you believe it's bad. But the data really doesn't support that well. It does say, the data does say, hey, we might have a little bit of a slowdown right now, but this is not a totally recessionary environment at this point. Now, will it happen in 2024, 2025? Possibly. I think it will just take longer than people think. So maybe we should appreciate the happy times that are here right now a little bit, because, the future is a bit more unsettled. I mean, if you look at metrics, the market may be a little overvalued right now. If you look just as purely at a price to earnings ratio situation, but then again, you've got situations in bonds that look attractive. As we say, every time that we meet, international equities appear to be undervalued relative to its U.S. counterparts. Whether or not, international stocks ever take off, I'm seemingly saying that for 15 years, but someday they'll have the day on the sun.
We keep saying it's the longest cycle of outperformance on record. At some point, things have to change. God knows when that will be.
Yeah.
But
maybe we'll be out of the industry by that time. Be like, we told you should have kept on, and you'll be like, you guys are 70, and you're like, I know.
No, and I think the just kind of as a country, I think people feel more polarized, more separated. There are still lots of kind of bad feelings that came out of the COVID pandemic, and I think it's carrying over. You think about, I think of the comparison to the 1920s, and you had the Roaring '20s. You had a world war and a flu pandemic in 1919, and people kind of came out of that and were like, hey, let the good times roll. Let's enjoy ourselves. Let's be happy. I mean, it ended in depression. Let's not go there. But the idea that, hey, things were kind of crummy. Let's enjoy ourselves. And I think in terms of how people are acting, they're taking more vacations. They're doing more of that stuff. It just hasn't translated to how they think about the world at large. People are feeling pretty good about themselves. They're just not feeling good about the world at large. So
yeah, there's definitely PTSD from COVID, and that will last years. Our mental health picture in the country is quite bad. I think a lot of that was due to a lot of isolationism and things like that. People have kind of isolated themselves to their houses. A lot of remote work, things like that have just changed the whole picture. So for all the positives you have in remote work, there's a lot of negatives there too. And so, it remains to be seen about whether we'll see a thaw of that. I would assume we probably would over time.
Yeah, a few people were like me who, I had friends call me in the early days of the pandemic, and they're like, gosh, you sound so chipper. And it's like, well, get to hang out at home with my dog, be left alone. So, more people like the socialization, I think.
I liked that for about a week. Then I was done with that. So,
I was like, this can go on forever. Just a lot of dog walks and Zoom calls. And
in-person Keith is way better than Zoom Keith. Right?
Well, unfortunately, people only get YouTube Keith. But
that's true.
I think good conversation. Hopefully we, addressed, I think, some of the things that are people are feeling in the markets, and we take these things seriously, but we do want to remind people, hey, the picture is pretty good. There was the talk of soft landing, and we seem to be landing pretty softly.
Oh, don't even say that. Don't even say that.
I don't want to jinx us.
Yeah. Just say our vibe session, chill out, everyone. It's not that bad, man.
Bro.
It's good. Bro, we're fine.
Yeah.
We're fine. No, we're going to be fine. Even if we go through a recession, it's going to be fine. I don't think that we're going to see some, I shouldn't even say it either. Some 2007, 2008. Samuel's over there already shaking his head at me don't say it, dude.
Don't. Yeah.
Yeah. Yeah.
Well, and I do think, Samuel's reaction there is also indicative. A lot of people fully didn't feel like they got back on their feet after 2008, 2009 as well. And so, there's all of that talk building in, and I think, maybe we need to, talk a little bit about building some resilience in ourselves too. It's been a hard 15 years, but it's not unprecedented in human history. I mean, just mentioned World War followed by a pandemic. That must have been fun, in the 19 teens. And then you had, 7-8 good years, and then you had a depression. So, but the markets will chug along. They've seen a lot, and the American economy, by the numbers, is in great shape, and more people are working. More people are, people are making more money, adjusted for inflation than they did before the pandemic. So, hopefully things keep going along.
Thanks for joining us on this episode of Give Me Some Truth. We'll tease also our investment guide. We'll have many of these themes coming up in the next couple of months. That'll be released just after the first of the year. If you have any questions on this podcast or comments, please leave that below. And as Stan always says, be sure to smash the like button.
Stan's here in spirit.
Walker Condon Financial Advisors is a registered investment advisor with the SEC. Registration with the SEC does not imply a certain level of skill or training. The opinions expressed by the participants of this podcast are their own and do not reflect the opinions of Walker Condon Financial Advisors. All statements and opinions expressed are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Information expressed does not take into account your specific situation or objectives and is not intended as recommendations appropriate for any individual. Viewers are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation. Past performance is not indicative of future performance.
You gotta leave your money behind you. Raise your hand to the sky. Ask the masses for silence.